Hello, my friends. Welcome on our webinar. Our webinar about the art of using the stop loss order. In this webinar, I will explain you how to properly set the stop loss order. Why the stop loss order is important? Because it protects your equity, your whole portfolio, really. So let's say you have $10,000 on the account, and if you don't want to lose half of this account in one trade, you need to have a stop loss order. Traders don't like stop loss orders because of two reasons. Well, first one is that they close the position on loss. And of course, they hate to close the position on loss. But second of all, stop loss order proves, shows them that they were wrong. And the thing is that humans don't like to be shown that they are wrong. Even when you argue, like with your friend or family or a stranger, and you don't have, and you're not right, and you have this idea in your head, oh, this person is right, I'm mistaken, I'm wrong. It's very hard to admit a mistake. It's very hard to admit that you are wrong, right? So sometimes you continue arguing. The same is with stop loss order. So when the stop loss order is activated, it means that you agree that you were wrong. And humans, they hate it. They absolutely hate it. That's why they avoid using stop loss orders. Now imagine on the market you can buy or sell, or you can stay without a position, but in general you can buy or sell. And imagine that you made a mistake, simple as it is. You made a mistake. Instead of buying, you sold, and the price is climbing higher. Does that sound like something weird or something not probable, not possible? Of course it is possible. Of course it is probable. You are not the best trader in the world. You aim to be the best trader in the world, but even the best traders in the world, they make mistakes. The thing is that when you make a mistake, you need to close your position. Because if you keep your position open and the market will go in the opposite direction, it will wipe out your account sooner or later. In my opinion, if you don't use stop loss orders, sooner or later, your account value will be zero if you don't use stop loss orders. So I encourage traders to use stop loss orders, and we have to use them wisely. We have to know how to use them properly. So in a previous analysis, I was in the previous webinars, I'm sorry, I was teaching you about supports, resistances, Fibs, about candles, technical formations. So now I will use this knowledge that you already have, and I will add the art of placing the stop loss orders in it. And we'll do this on the whiteboard, as you can see. And now I will draw just random examples that I think will be the best to teach you how to use stop loss orders. First of all, how big should the stop loss should be? I'm not saying, I'm not trying to tell you where the stop loss should be now, but how much money can you lose on one trade? And the answer is from 1 to 2% of your equity. And you may be saying or thinking right now, that guy's crazy. Only this? Such a small positions? How can I buy Lamborghini after opening such small positions? Guys, trading is eating with a small spoon. You have to be aware of this. You will not get rich overnight. Even with cryptos, you will not buy a Lambo after 1 month of trading. So you have to trade using small orders, small position sizes. In consequence, you will have small losses and bigger profits definitely than losses. So stop loss order should close your position on loss, and loss should be not more than 1 or 2% of your equity. So let's say if you have $100 account, stop loss order should be $1 or $2. In 1,000 account, stop loss should be $10 or $20. You see where it is going, right? $10,000, $100 or $200 stop loss. Okay, but then how to set this stop loss? Clear, very fast, convenient example. We have a support here. The price is going here. Then creates an inverse head and shoulder formation. You know inverse head and shoulder formation from the previous webinar. Here is the neckline. We don't have blue. You open a position here. Here is buy. And now you have $100 account. How big the position should be? First, you need to know where the stop loss should be in order to open a position. Because remember that you can risk only $1 or $2, but let's say 1. In this case, let's use this. So if you're buying here, you don't know which position size yet. You know that you want to buy here. Before you will estimate how big the position will be, you need to know where you will close it with a stop loss order. So before opening a trade, you need this knowledge. You need to know when you will close it if the price will not continue to go higher, but your thinking about this position will be wrong and the price will reverse. So you need to know this. You need to be aware of this fact where you will close your position on loss. You have two options. First one, stop loss can be placed under the horizontal support. So this is a support and under the right shoulder of the inverse head and shoulder formation. Why? I will explain you a bit later. Or you can place it here, below the long-term lows, below the head, and below the horizontal support. So in this case, stop loss will be, let's say, 100 pips. But in this case, will be, let's say, 200 pips. I will not calculate the value of the pip. It's not the idea now. But I just want to show you that if, and still in both cases, you can risk only $1. So those position sizes cannot be equal. This will be, okay, let's use this one. This one will be twice as big as this one. So this one will be half of this position. So if here you're opening one lot, of course you will not open one lot because that will be too much. In this case, you can open 0.5. Why? Because stop loss is further away. So you are risking more pips. So your position has to be smaller because you're risking more pips, but the pip value has to be smaller. Here you have a tight stop loss, so position size can be bigger. And that, my friends, explains you perfectly. Here is a resistance. Here is a support. And that, my friends, explains you why you don't open a position here or here or here or here, but you open a position here or here, as close to support and resistance as possible. Why you don't open a position here? It doesn't matter if long or short. It doesn't matter. You don't open here because stop loss for the short position will have to be here, and stop loss for the long position will have to be here, a long distance. If you would open position here, stop loss is here. So it's not 100 pips as in this case, but it's 20 pips. In both cases, you can lose only $1. But here you would have to open, let's say, 0.1 lot. And in this case, you can open 0.5 lot. Which means loss is the same because you're losing $1. But when the price from here will go here, you will earn $1 because the price made 100 pips. And in this case, price will make significantly more. Like here are $2, almost $2-3 instead of $1, because the position will be bigger. Actually, $5. It doesn't matter. I'm just saying that it will be significantly more, my friends. So that's why you need to open as close as possible to supports and resistance. So now, let's go through this knowledge that you already have from the previous webinars. Let's deal with the art of placing stop loss orders. So first, resistances. Or like this. There is a head and shoulder pattern. Price drops. There is here, price drops, and you decide to sell here. Where is the stop loss order? Well, you need to take into consideration this resistance. This is resistance here. It was support here. There is also downtrend line. So your stop loss should be above this resistance and above the uptrend line. You need to remember to calculate the swap as well, because you are selling with bid, with the lower line, and you are closing short position with ask, with this, with the other price, with the higher price. So you're opening short position with the lower price and close it with a higher price. So you need to also take this into the consideration. So in this case, you place your stop loss above those two resistances. Why? Because in general, the price should continue to go lower. But it can reverse, and when it will break this resistance and this downtrend line, it will mean that new uptrend started. So you don't want to be with a short position when the price will go there, right? Why should you do this to yourself to keep a short position open? And here, if the price would do something like this, and here you would be praying like, oh my God, what have I done? Most probably the price will reverse. I hope it will reverse, but the price will continue to go higher and higher and higher. Okay, supports and resistances. The same with supports. So here is the support, here is the resistance. Resistance, support. Let's say price drops, creates an inverse head and shoulder formation. Oh, okay, like this. Let's go like this. Like this and like this. Like this and like this and like this and like this, and let's say like this. You buy here where the stop loss should be, of course, here below those lows, not on those lows, because the price can do like this, test it again and climb higher, so it should be slightly below. Just give the price some space, give the price room to move. You buy here, stop loss is here, you risk like 100 pips, and then here 100 pips, 100 pips, 100 pips. Stop loss is below significant support. If the price bounces from this support, stop loss is below the support. Price breaking this stop loss would mean the continuation of a bearish trend. I wouldn't like to stay with a long position here if the price will continue to go lower. Why should I? Just close your position and move on. Why should you do this to yourself? Why should you torture yourself? There is no absolutely reason to do this. Just close the position and move on. Let's do candles. You remember candles, hammer, shooting star, bearish engulfing, bullish engulfing, and Maruboso. We talked about those candles. In the hammer, price drops, finds a hammer on a support, and then after hammer, you can buy after the hammer is finished. Here, stop loss don't go below the support but goes below the tail of the hammer, and that's your stop loss. Let's say 60 pips, and fingers crossed for a further upswing. Shooting star, the same. Shooting star on a resistance. It's always better to trade shooting stars and hammers on support and resistances instead of just randomly, because when they are present on support and resistance, they are much stronger. So you have an upswing here, price creates shooting star, you sell. Where is the stop loss order? Not above the resistance, but above the long head of the candle. Of course, take into the consideration the spread. So it cannot be on the top. Just consider the spread and give the price some room to move. Bearish engulfing. The price climbs higher, creates bearish engulfing. Here you are, you sell. You are on a resistance. Stop loss is here. Period. Bullish engulfing. Price drops, creates bullish engulfing. Bullish engulfing is created here. You buy. Stop loss is here. Marubozu. Marubozu breaks resistance. Before Marubozu, price goes like this. There's Marubozu. Marubozu finishes here. You buy. Price is not below the resistance, but price is below Marubozu. Simple as this. That's about candles. Fibs. $23, 38, 50. Uptrend, correction starts. 23 goes to 38. We have a bounce. You buy here. Buy. Stop loss is below 33. Hopefully, the price continues the upswing. That's it. That's the Fibs. Of course, I told you that 61.8 worked, that 38. Just the matter is that it's a support and stop loss should be below support. If you trade bounce from the support, then stop loss is below, because if the price drops below the support, it means that support is gone. Your initial thinking about the trade is gone. Bullish sentiment is gone. And you should close your position. Simple as this. Move on. Look for something else. Technical patterns, my friends. First trend reversal patterns. Double top, head and shoulder pattern, double bottom, inverse head and shoulder pattern, and triangle. First the triangle as a trend reversal pattern. You have a breakout. You sell here. Where should be the stop loss? That's a tricky question. Because there are few answers, few ways to place properly stop loss. First option is to find the middle of the triangle and place the stop loss above this middle of the triangle. Another school is to place the stop loss above important top, last important top. And another school is to place above Marubozu, if the breakout was with Marubozu candle. But also look at this. So that's the end of the triangle. It's longer here. And what the price is doing, the price is doing this and this and this and this and this. And then you sell. In this case, if you sell here, I would place stop loss above the last important top. Not about this one, the contact with the resistance. It's too far. Last important top. Why? Because very often price comes back here and then it drops. But if the price would come back inside of the triangle and then climb to my stop loss, that would mean that this is a false breakout. And most probably after this, we're going to have a significant upswing. Okay? Here, double top. That's a neckline. You sell here. Stop loss above the second top. Double bottom. You buy here. Stop loss below this top. Head and shoulder pattern. You sell breakout of the neckline, right? You remember. Stop loss before the right shoulder. Inverse head and shoulder pattern. Here you see no buy signal yet. You need to see the breakout. Here you buy. Stop loss below the right shoulder. Those were, my friends, trend reversal patterns. Now trend continuation patterns. Here is rectangle. Here is pennant. Here is wedge. Here is flag. Here is other wedge. Here is other flag. Let's see. That's pretty easy. Downswing, rectangle, price breaks the support. You sell here. You can place stop loss order above the rectangle, but if it's a big rectangle, then the principle as from the symmetric triangle applies. So below latest important top or above the Marubozu candle, because usually, again, breakouts happen with Marubozu candles. So above this candle. Pennant. Pennant is a symmetric triangle, but in a shorter term and with usually promoting trend continuation. So you sell here, stop loss here. Why here? Not in the middle, because they're usually smaller. So it will be still relatively small distance. Wedge, upswing, correction. Buy. Here, stop loss below the last contact with the support would be too far. You can place it in the middle of the wedge or below Marubozu candle, just to make the position smaller, but still relatively safe. Another flag, upswing. You buy here. Principle is the same. It can be in the middle. Here is too low. Usually, again, when it's happening with the Marubozu candle. So you buy here, stop loss here. It works. Another wedge, but this time in the downtrend. And sometimes there's no break straight away, but there's the small bounce before and then a breakout. You sell here, and stop loss can be really placed above this small top. And a flag in the downtrend, correction. There's this small thing here. Of course, you will be saying that it has to be flag, so it is a flag. Breakout, sell signal after the breakout, stop loss above this small top, and a drop with you on board with a short position. Why? Because there was a breakout from the flag, which gave you a sell signal. Simple as this, very convenient, beautiful, smooth. And that's it, my friends. Of course, after a single webinar, which lasted half an hour, you will not be the master of placing the stop loss order. But if you will go through this class over and over again, you will catch the main idea, the story behind placing stop loss orders. And now all you need is experience. And the thing is that the place where stop loss order, etc., it's important, of course. But the most important is to start using stop loss orders, right? This is what is most important, because most of the traders, they don't use stop loss orders. But if you will start using them, definitely your trading results will get better. That's a paradox, because you will start making losses, but your results will increase, because you will get rid of big losses. You will have small losses, but you will get rid of huge losses which are destroying your account. Because you can have a bad trade and lose half of your account, and to lose half of your account when losing 1% of a trade, you need a lot of losses. All right? So you have a lot of time to learn, to experience, to gain knowledge. So my friends, I hope that it was eye-opening for you. If you didn't use stop loss orders, really don't be afraid to make loss on the forex market, because it just happens. It is like this, and just deal with it. That's just the normal part of trading, to make losses, but you need to make smart losses, okay? Don't make stupid losses, make smart losses, 1-2% of equity on one trade. Place those stop losses in important levels and crucial levels, and enjoy the trading. Thanks very much for watching this webinar. We're gonna see each other on Thursday again with another topic. So thanks very much, and all the best in your trading.